You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
All right, everybody. Welcome back to Options Playbook Radio, the program here on the old network, where we break down the impenetrable fog of options into some easy to digest, easy to understand offensive and defensive plays. You want to go on offense, maybe make a little income, maybe get a little capital appreciation. You want to go on defense, protect those gains. We got you covered here on Options Playbook Radio. My name is Mark Longo from the old optionsinsider.com. If you're saying to yourself, wait a minute, hold the horses, this isn't the usual host of this program, you are correct. You get a penny for being a good listener. And then B, it's coming towards the end of the year. It's a great time to answer some listener questions, and to help me to do just that, we got my old friend, your actual host of this program, Mr. Brian Overby, the senior options analyst, aka the options guy, over there at Ally Invest. Brian, welcome back to Options Playbook Radio for what's probably going to be one of our final huddles of 2018, sir.
All right. Yes, definitely. Thank you for having me, I should say. It's always wonderful to get up with you, Mark, and answer some of these listener questions. I mean, one of the biggest things is there's just no way to answer them all as they come in. So they pile up a little bit, and it's always great to get together and huddle up.
It's time to huddle up and answer questions about your favorite options plays. Submit your questions via questions@theoptionsinsider.com, twitter.com/options, facebook.com/theoptionsinsider, or via the Trader Network at tradeking.com.
All right, let's get to it. As Brian mentioned, we got a backlog here of questions from throughout 2018. You guys have been hitting us up. Hopefully we've staved off enough of them here, but we still got quite a few to get to, so let's get right to it. First up here, we've got, by the way, like I mentioned, this is one of our high-stakes huddle episodes. If you send in a quality question, then perhaps Brian will select you to be the winner of a brand spanking new hard copy of the old titular Options Playbook. So bring your A game when you're writing into the huddle, and then you too can have the luxurious new book smell of opening a fresh copy of the Options Playbook in your own precious little hands. So send in those good questions. Let's start off here. Let's see, maybe this will be our winner. This comes from Doc Quinta. He says, hello, Brian. I'm writing in because you're the stock replacement guy. I guess that makes sense. You do talk a lot about stock replacements, aka the fig leaf strategy. We all know that's one of your favorites alongside the skip strike butterfly. He goes on to write, I've been lured in by the ongoing sell-off in crude oil, and I'm thinking about setting up a longer-term stock replacement strategy in the USO ETF. I have a couple of questions. All right, first off, he asks, with USO dropping below $11, is it even worth doing? Or should I just buy the shares instead? Is there a certain threshold where stock replacement stops making sense? Excuse me. B, second question. He asked, my proposed construction is an almost 6-month strategy with using the July 8 calls. He puts in for a price here of $310. So my outlay for 100 shares would be $3,100 versus $10,800 if you bought the stock. By the way, USO right now, listeners, hovering below $11, $10.82 as of our recording here. So yeah, obviously WTI and crude oil have taken it on the chin of late. Even post OPEC's reductions has not been enough to stem the concerns. USO hit a 52-week high of about 16 and a quarter back in early October, and now it's hovering right around the 52-week low of 10.5. So yeah, it's been kind of all downside the last couple of months here for USO. USO, of course, is the United States oil ETF, attempts to try to track WTI. It's debatable how well it does, but it attempts to try it. And then the third part of the question is it even worth selling a Jan 11 half call and limiting all my upside just to collect 15 cents, or should I keep it open from here? Well, Brian, there's a lot to unpack here. He sent it in to the right person because you are indeed the stock replacement guy on our network, for lack of another choice. You get to wear that hat now. So a lot of questions here. First off, doing stock replacement on cheaper stocks. Usually the threshold's $10, but you can go with 11. That's what they ask. Is it even worth doing? And then B, do you like his setup of doing these calls for about 6+ months? It looks like about 7 here for about $3,100 versus buying the stock outright. And then B, he's looking at. It sounds like he doesn't mention it, but he looks like he's doing your fig leaf addendum, which is selling a near-term quasi-covered call, synthetic covered call, fig leaf, call it what you will, and getting a little bit of income, but he says he's only going to get 15 cents for it. So is it even worth doing? A lot to unpack, Brian. You can have it any order you want, sir. A lot coming in from DeQuinta.
All right. Well, yeah, interesting to see the USO this low. And I think I just kind of start by addressing the underlying. It's a popular underlying. It's heavily traded, but it still has.
What are your thoughts on USO? Are you a big fan? It's got a mixed reaction among people I know.
Right, and that's I guess what I was addressing a little bit is the choice of the underlying. You're saying that it is a $10 underlying, and in general, I would probably just buy the underlying. But you can get into it. You're looking at probably an 80 to an 85 delta call option from what you said, and that's usually the case. You're usually buying those 80 deltas on almost anything that you're looking to trade, and you're paying about 25-30% of the actual cost. Now, with that being said, on the USO, if I'm looking at a longer term strategy, the expense ratios are just fairly big. You look at a lot of these weird ETFs, or not, I shouldn't say weird. Weird is a wrong term, but these things that are trying to track futures prices and just not basic stocks overall. A lot of times these things just have high expense ratios. And as a longer term outlook, you got to realize that expense ratios just keep coming out of it. And they're not necessarily meant to be long term investments. Now, USO, that's very popular, and it's right on the cusp, I would say, as far as expense ratios relative. But if I'm looking longer term, I would maybe look at some of the leading just oil stocks in general, and maybe think about doing this strategy on a little bit higher price stock. And a decent dividend, so the call option will be fairly cheap overall, yada yada yada. But so with that being said, that's my I'll get off my soapbox about the USO. Now, the question is, it's dropped below. Let's say that we like this underlying. Let's say that we want to do the strategy on a $10 stock. The one thing that's nice about it, and this is a big problem with stock replacement, is the USO has very liquid markets. And when you get deeper in the money on longer term options, a lot of times the width of the bid-ask spread is too much. And in this instance, in the USO, I feel like it's not going to be that bad. The one benefit of having a $3 option be an 80 delta option, as you were talking here in this instance, you had it for $3.10. The July 8 strike call is what you were saying. The market is going to be tighter just because of the price of the option is cheaper. And why is the price of the option cheaper? Because it's a $10 option. All right. So there are some benefits to it. So I'm not opposed to it. If you want to hang in the USO, I don't mind this strategy. Yeah. And I think Mark kind of hit it on the head. You're right on the cusp, being right at $10 as opposed to just buying the stock outright. Now, one of the other things here is that it's been very volatile for something that's not supposed to be volatile. It has been volatile. And so you're really not getting paid a ton for these option contracts. But I do look at that July volatility, and I'm seeing it at about 35% all the way out in that July expiration, just by looking at the volatility in general. But 15 cents is hard to justify, but on a percentage basis, on a $3.10 option, that's still 5%. The problem here is that, do you buy it back at a nickel? Do you buy it back? You got to hope you can buy it back at a penny. So if you put it on for 15 cents, you're just basically going to let it ride, because there's really not that much to play with. The last 5 cents or so is going to be really tough to suck out of that call option. But if you looked at it as a 15-cent option on just owning the stock in that instance, then you're talking about only a 1% premium that you're bringing in on a $10. And in your instance, it was at that point in time, I think what was the stock, $10.10 or something like that. Right now, I'm showing it at $10.80. So in that instance, you're talking about only bringing in 1%. And I really wouldn't do that when I'm looking for a big bounce up on the underlying stock. I don't think that premium brought in should be done with the way the market conditions are. You have set yourself up for a lot of risk on the downside on a volatile underlying that has specifically been volatile recently, and you're capping your upside. And so in this instance, I don't mind the stock replacement. I don't mind it. I'm not big on the choice, the vehicle that you're looking at. But I'd say, why not? Go on out. If your forecast, because we're not meant to be any recommendations on Options Playbook Radio, if it's your forecast, I don't mind using the option marketplace as a stock replacement, and it's mainly because the markets are so tight in this underlying.
Yeah, I pretty much agree with just about everything you said there. I'm also quite dubious of USO. It's not my favorite. I don't think it does a great job of tracking WTI. That's why I'm on my shows like TWIFO. I usually recommend going straight to the source and trading WTI options, or indeed the futures if you can handle the futures out there, because that's going to track a lot better, because it is it. That's a one-to-one tracking out there in WTI versus all these ETPs that attempt to do this. And you're right, expense ratios, they have roll yields, all these things that erode them over time. That's a big use case for products like this, is to try to have a long-term buy and hold, and that's not exactly a thing you want to do with a product that's eroding due to expenses and roll yield all the time, right? And also, this person selling that call for 15 cents. This thing was trading $13 a couple of weeks ago. You don't want to give away all that upside. He's 11.5. That's capping a lot of your upside for 15 cents. I'm not a fan of that at all. And the same thing. If you want to do it, go for the stock replace. I would point out, by the way, just a note to say, most equities you can probably buy on 50% margin. So the outlay would be about $5,400 if you did it on margin versus $3,100 for the call. So it's not quite the total savings. I see what you're getting at with that. If you did it on margin, you give a little bit more capital efficiency. But obviously they're going to charge you for margin. So if you're interested and you like that, and you understand all the caveats that we just laid out, that none of us are huge fans of USO, then that's definitely probably definitely a much more capital efficient way to go than going out and just loading up on the underlying. Even though it is cheap enough that's getting to the point where buying the underlying and buying the options are getting close enough where you can make a good argument that maybe doing one versus the other is the better way to go. All right, that was a pretty epic one, so I think we'll take it home with an easier one to kind of cleanse the palate here for the show, and probably for the huddles for 2018, unless we have time to squeeze in a few more. This is an easy one, Brian. It comes from Jansport. Here's a couple everyone's got multi-part questions. First off, he says, does Ally allow him to close short options positions, below a dime without a fee? And also, if he wants to actually buy a hard copy of the playbook, is that possible? Well, for the second part, you wrote a question in, so you're in the drawing you're in the running for that one. So maybe we can answer your questions there. But also, Brian, I'll let you right in to answer the first one. That's a common question we get a lot. Anyone who's out there harvesting premium, they want to know what the cost is to close it out when it goes their way. So let's start with that, Brian. What is it? What do you guys charge to close out a short position that has gone his way? And then B, where can he get his hands on the playbook?
Well, a couple of that, and I think I understand the question overall about the playbook. And here's what's going on is the options playbook is no longer for sale on Amazon currently going into this wonderful holiday season. And that's mainly because we sold out of the old company books that we used to be back in the day. And we have now got the new Ally version of the book, and it just needs to get posted up on Amazon. So currently there is no way to buy the hardback cover of Options Playbook.
You're too popular for your own good, sir. You sold out.
Yeah, we sold out. We sold out all the previous company books, and now we got our Ally books, and that means that there's a new USB symbol on the back, and so a whole new page has to be made up, and compliance issues and all that other stuff. They do have the Amazon Kindle version that is available with the Ally logos and everything, because that was a simple one. But on the hard book, that's not out there, and it's not available for sale right now. But you can always go to optionsplaybook.com. Every single word of the Options Playbook is there for free. So I really love the fact that you would that you're asking the question, and it allowed me to have a great answer. So what do you say, Mark? Why don't we send him an Options Playbook? I kind of think
he does want the book. So I guess we could accommodate that request. It is the season of giving here, sir. Should we not give to our friend here? And otherwise he's got to wait for it to come available on Amazon. Or read it on the Kindle like a schlub, you know. He wants to feel those pages in his hand, Ryan, right? So I guess we could accommodate him. All right.
And it allowed me to address the question that I kind of forgot that I needed to address. So
there you go.
I appreciate that.
It's a win-win. Let me see if I feel like we're giving the people one more. Let's try to find a really quick one we could close out on here. These are all so very elaborate. Let's just see really quickly.
And we weren't doing the Options Playbook promo yet, so he didn't even know that he could potentially get one.
Here's maybe a fun one to wrap up on. Just maybe it's an interesting thought question. You talk a lot about flig leafs and other strategies that are interesting, but they're relatively straightforward from a commission perspective. This guy Richard here asked a while back, are there any trades that if you did not have to pay a brokerage fees, would they be excellent types of trades? So I'm assuming he's leaning more towards the, multi-crazy leg iron condor reverse ratio swaps and things that are, 64 legs that would be prohibitively expensive. Is there anything that you would love to do that is just too onerous that if it didn't have commissions, you would be all over, Brian?
Okay, all right.
I threw you a curveball there at the end of the year. Are you a big fan of maybe we'll look at it this way. Are you a big fan of really multi-leg things like condors? I know you like skip strike flies, like condors, or like some of the other ones that are iron flies that are very leg intensive, maybe even iron fly, swaps and things like that are super, shall we say, leg intensive.
Yes, yeah, definitely. And you hit the two on the head. Obviously, I've talked about skip strike flies, and main reason why I talk so much about those is I just kind of look at earnings reports, and those are interesting trades to do around it, even ratio spreads. But the iron condor, which I honestly don't address that much in Options Playbook Radio, because to me, an iron condor is a trade that you'd want to do week in or month in and month out. And it's a total income oriented trade, which I view it a little bit more of a non-directional trade than I do a lot of the times when we're talking about the butterflies. So the fact that I would be just and the risk reward is much different too on an iron condor versus a butterfly. So not paying commissions on iron condors where you're hoping to bring in 50 cents or $1 every time you do them, and that commission will eat away at that. I definitely would say that the iron condor as a full-time strategy is something that I would consider much more than some of the other trades that are out there. If butterflies were free, I think that's a song or something, right? If commissions were free at brokerage houses.
Yeah, I used to have a host on one of my shows who used to always say that iron condors were iron butterflies for cowards. I always thought that was a great saying. Do you subscribe to that? The iron fly, obviously a lot closer to the fire. You're selling or buying an at the money straddle, obviously, than doing an out of the money strangle versus the condor. You're building in a little bit of cushion. You ever use an iron fly, Brian? Or you more? I know you like the skip strike fly, but do you ever use an iron fly, or would you prefer a condor? You had to go that approach.
Well, the iron, I guess the iron fly, I would be tended more. Where would I use it is the question, and that's what Options Playbook Radio is all about. If I could rephrase it just a little bit, is I would use an iron fly much more if I was doing the butterfly right at the money, because then you have the possibility of it going one way. You adjust the trade that's going against you, and you let the other one expire worthless. And that's one of the big benefits, is that you're doing two short spreads as opposed to buying a long spread and a short spread. So in that instance where I'm doing a butterfly right at the money, that's when I would probably want to do an iron fly, more so than the regular fly. But if I'm doing anything directional, I want to stay either all calls or all puts, i.e. like almost all the strategies that we've talked about around earnings on these big multi-leg trades.
All right, Brian, we've squeezed in as many as we possibly can here for our last huddle of 2018. But if listeners want to get at you here in the new year, maybe they want to be featured on the first huddle of 2019, Brian, where should they go? What should they do?
Well, if you'd like to get a hold of me, you can always get to me through Options Insider Radio. But send me a question directly at theoptionsguy@invest.ally.com. That's my email address, is theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place in the new year. So until then, may all the options that you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.